Major indices all having their worst day since September 6th as Iran reportedly prepares for a missile attack against Israel, fueling investor fear of a wider conflict in the region. To discuss how investors should be positioning their portfolios, we have Rob Haworth, who is the U.S. Bank Wealth Management, and ultimately here as we think, Rob, about what this means right now. I mean, we saw the volatility index, or at least the CBOE volatility index spike, the fear gauge index, if you will, on this news today. How should investors be positioning their portfolios given that volatility spike once again, and not driven this time by economic data?
Right. No, not driven by economic data. Unfortunately, driven by conflict and fears and concerns here. I think what we've seen historically from conflicts is this does tend to be short-lived. We try and look through this and look at the opportunities that may arise as we see equity prices soften here a bit. I think the key question is what really happens to U.S. and global economic data in the wake of any attack or continuation of this conflict. And that's maybe where the epicenter is oil prices, right? And we are seeing oil prices come up, but they are still at quite low levels if we think about where they were just last year, earlier in the conflict. So I think that's maybe the good news is oil prices are not elevated yet, even though there is, to your point, heightened fear in these markets. So we would look at this as more of an opportunity to extend, to look at maybe lower quality credit on the fixed income side, and then even within the equity portfolio, start looking at those areas where you've been trying to shore up your positioning. It is a tough day for many of the more income-oriented sectors like financials and industrials, but that's maybe an area to start to look for bargain hunting should we see this sell-off extend a little bit.
You know, it's particularly interesting as we're going to be watching and listening to what vice presidential candidates have to say this evening. And this could be a topic that gets brought up in geopolitical tensions and how either of them underneath of the presidential candidate for their respective parties might address this and might be prone to step into how the U.S. would also govern itself with any type of geopolitical concerns. And so what are you expecting to hear from them that could kind of translate through to how either of their parties would operate, and thus the markets and investors would have to price in as well?
Well, our own work tells us that really what matters when it comes to the market and is the economy, right? How does this impact the economy? What we've heard in the platforms for both parties is really that they're looking to tighten up on trade, particularly trade with China, right? So we already know that there's some similarities here amongst the parties. I think what we're really looking forward to is what are the differences and how does this kind of impact the result? But for us, when we look really at the markets, what we see is it hasn't mattered. It hasn't mattered if it's a single party rule, if it's Democrats, Republicans, if it's mixed. It really comes back to how is the economy doing? And I think the good news for the U.S. right now is the story is still a positive one. We're still seeing positive revisions for economic growth from consensus economist expectations. The story is still one of solid economic growth, slowing inflation, a Fed that is moving interest rates down and poised to move interest rates lower over the rest of the year and well into next year, and maybe get to neutral eventually. So I think those are the key factors that will really drive the market. For us, I know everyone's really looking for, kind of who gets the edge here in what is a very tight race. But for us, we're focused much more on the economic outcomes, which appear well in hand for the Federal Reserve.
And what you had mentioned and what you ended on there just a moment ago in the Federal Reserve, I mean, the anticipated rate cuts to come here also being factored in largely to anybody's portfolio playbook right now. And so what are some of your favorite sectors or your top sectors that you're tracking amid that policy pathway for the Fed?
Yeah, we keep looking for. I mean, we think that the Fed move in September really rang the bell for investors that are stuck in cash. That they need to start their transition now into what they want their portfolio strategy to be. On the fixed income side, we'd look towards things like catastrophe bonds or reinsurance. We'd look towards high yield munis for those in higher tax brackets. We'd even look towards things like securitized credit, which offer some extra yield here. We think that's a good way to transition out of cash. On the equity side of the ledger, in the long term, we still think technology and communication services have significant value, but that's more of a long-term play. The challenge right now is those valuations are elevated. In the near term, we look at income beneficiaries that have maybe had a tougher time, financials, industrials, maybe not energy today, but certainly eventually.
Rob Haworth of U.S. Bank Wealth Management, thanks so much for taking the time here with us today. Appreciate it.
Thank you.